Good evening, everybody. Jerome Powell came out today and he ignited this stock market rally. We gapped up to start the day, went a little higher, and then we faded to fill this morning gap. And when Jerome Powell came off, boom, we were off to the races. We're going to take a look at the updated Fed Watch tool today, take a look at yields, volatility, and some interesting stuff taking place here on Friday, OPEX, all that and more on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. If you haven't done so already, make sure to smash that thumbs up. Let's get into it. Alrighty, people, welcome back to the show. So this was actually yesterday we talked about this, the federal funds effective rate, and how Jerome Powell was basically saying we're going to hold rates higher for longer, and the market was pricing in rate cuts going into May of 2024. Well, let's go ahead and look at the updated version. So what is the market doing now? Now they're saying we're going to start cutting in March, and Jerome Powell was quite dovish in today's meeting, which begs the question, what is he seeing? What does he know? Why is he kind of leaning this way? We'll see if that changes throughout the course of time, but the market was quickly to price that move in. You can see the 10-year yield fell dramatically down 4.11%. We're still within that target zone of this head and shoulders breakdown, but if we start breaking below 4, it opens the door obviously much, much lower. If you take a look at bonds are up 2.35%, looking at TLT as the proxy. So this is a pretty large move in a very short period of time. The 10-year, 2-year curve was actually up on the day, and that's typically not the greatest for markets, but the 10-year, 3-month fell. And very interestingly enough, so if I pull up the 2-year treasury yield, the one-day rate of change, this was a large drop, 5.71%, closing at 4.46%. We haven't actually seen a one-day drop like that since in and around the time of when the Silicon Valley Bank blew up there in March. And the reason why I'm showing the 2-year is because the 2-year really does track the federal funds rate really well. You can see the red line is the 2-year, the blue line is the federal funds effective rate. So it seems like the market is saying, yep, now we're going to get our rate cuts. And if you zoom in closer to this chart, you'll notice that throughout time, right? So 2000 going into 2007, 2006, and then right now, even over here too as well, what you'll notice is the 2-year typically falls first. That signals it. And then the rates potentially follow. Well, you can see right here, this started going down, right? It was a lower rate than the federal funds rate, and then it started going down. It started crossing down here. Federal funds rate finally crossed down and went lower there too as well. Well, we actually had a lower rate, back here in and around 2022, I believe that was. I'd have to zoom in, but you can see now it's actually going to drop a little bit lower, potentially telling us that yes, we will be moving rates down lower. In yesterday's episode, we talked about what has happened in the past during these same exact times with the financial markets. Take a look at the dollar. The dollar also got just completely hammered today, really helping out that strong move in the S&P 500 and various assets. But interestingly enough, copper didn't play much of a role today with that dollar down. And there's typically a strong negative correlation. If you look like at a 20-day rolling correlation, it's typically most of the time in negative territory. When the dollar goes up, copper typically falls. But when the dollar drops, especially how far it dropped today, copper usually rises. And you can see we're actually scorching higher here on the S&P 500. But copper yet is not really following suit, which is a little bit interesting because Dr. Copper here, it's known as Dr. Copper, which is a good gauge on economic activity, just hasn't really been following suit in this rally. If we take a look at the 11 sectors that make up the S&P 500, what led the way? Utilities, real estate, healthcare, consumer staples. You'd look at this and you'd say that's pretty, risk off type behavior, but understand that these are very rate sensitive sectors, and that could be very well why they are leading the way. Utilities up 3.78%, real estate up 3.6%, and everything across the board here was in the green. Small caps really did lead the way, 3.35%, so quite the squeeze there in small cap land. Interestingly, though, risk off type behavior, technology was down there towards the bottom of the list, which I find to be quite interesting. So equal weight obviously did much better. So a lot of green on the overall board, but Microsoft actually finished flat on the day. Meta pretty much unchanged. Google rather unchanged. So none of these really played a role except for Apple, which is obviously the largest mega cap stock in the S&P 500. So seeing these type of days are, pretty rare, especially when you have a VIX down here at, a 12 handle. And what I mean by that is when you see VIX down there at 12%. If you take a look here at the VIX value, right around 12, you go to it around a daily, you can see what the implied move technically is, and it's 0.76. And while the S&P 500 was up 1.37%. So, about a 2 standard deviation move, which I'll show you based off the options chain, that is actually what we did hit. We hit a 2 standard deviation move and actually closed outside of that on today's announcement. So that's pretty big stuff as he's signaling those rate cuts. Let's take a look at the S&P 500 on the 15-minute time frame. Remember, we're still above a gamma level, we're still above an inclining 5-day moving average. What's that mean? It means that you look to buy dips, right? And you want to stay above an inclining 5-day moving average. Once it starts flipping back down and price gets under it, that's when it gets bearish. Now, obviously, price got pretty extended, which we talked about right here. Well, we gapped up. We said just be careful there because it possibly can reverse. Well, it did. It's in positive gamma territory, right? It came to fill the gap. That could be potential support. It ended up being support, and then the binary event took place. We don't know what's going to happen. This could have went like this for all we know, but Jerome Powell came out, and it was very dovish. The market liked it, and it pulled us outside of the weekly expected move and into that large call wall that we have been talking about, starting to open the door now to 47.50, which is the next call wall, the bigger call wall up above. Now, remember, 68% of the time we close within the weekly expected moves, but remember, we'll see what kind of, if we're going to get some follow through as we closed around the high of the day. It's typical to start moving up in the aftermarket session and potentially push a little bit higher going into tomorrow. So we'll see. Take a look at the Dow Jones Industrial Average reaching an all-time high. Okay, so that's a pretty big move right there. It's been straight up on the weekly time frame. The SPY actually did hit an all-time high today when you adjust it for dividends. Now, when you unadjust it for dividends, it's not at an all-time high. But just so people know, the SPY actually did reach an all-time high when you include the dividends there. Q's same exact thing, reaching an all-time high when it's with dividends, but it's different obviously if it's unadjusted. And then IWM is still range bound. Boom, 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 right? We're still, strong moves up, strong move down, strong move up, strong move down, strong move up, strong move down, strong move up, and we'll see what comes next. Let's take a look at this SPX plus SPY notional. Total notional open interest set to expire. This is a chart by Tier 1 Alpha, and you can just take a look here. It's pretty amazing to see this. This is, they had mentioned that this is on course to be the largest option expiration in history, with a staggering 3.1 trillion in notional open interest scheduled to expire this Friday. And that could bring a lot of volatility. It might not. They also posted this chart of SPY returns when you exclude the week of OPEX. Okay, now this is pretty interesting. So the green line, this right here is the SPY. Okay, that's the SPY chart. But when you exclude, when you get out of the markets and you stay in cash, 100% cash during the OPEX, the week of OPEX, the red line is actually showing your performance of that portfolio. So kind of interesting that it can make that dramatic of a difference when you pull yourself out of that kind of volatility type environment. Now, if we take a look at the bullish percent index for the technology sector, we have another high right over here, and the RSI is not confirming, meaning a negative divergence. We've seen these plenty of times throughout history, and it's finally getting to that really frothy area there too as well. So just be aware of that. It's building. It hasn't confirmed yet, but it is building. I want to close off by showing just an interesting chart, and once again, kind of going over the basics of technical analysis, and that's one of the basic principles is that markets and assets, they move between range contraction and range expansion. One of the indicators that I provided here on Twitter that I looked at was looking at the volatility bands, the bridge bands, and this right here is something that I had coded to show me the width of those specific bands. It's very similar like Bollinger Bands, but this one's reactive a little bit more. And we were actually at the lowest point, which means we're at the tightest contractionary point since way back over here, and that was November 23rd, 21. And we had mentioned that, do not be shocked to see some explosive moves, plus or minus, right? Because you don't know, you just want to follow trend. We're above a 5-day moving average, positive gamma territory. So likelihood of up, makes more sense in the near future. And that was posted, I think on the 9th or the 10th or something like that. Well, here's the updated chart. So we were right down here in this level, and this was that explosive move. So now the bands, they're starting to widen out. which means what? That means this line goes up, and it allows for wider price swings in the S&P 500 as price is starting to, obviously, or volatility is starting to expand, right? So contraction leads to expansion, and then eventually what's going to happen? Well, we're going to contract again, which means we're going to consolidate, we're going to pull back, etc. That's all I got for you on today's episode, everybody. Hope it helps out. See you later.